Welcome to another one of We Are Money's really rather useful videos in which we'll explain the different types of interest rate options for mortgages. There are four main types of interest rate product available to UK mortgage borrowers: fixed, variable, discounted or tracker. These rates are referred to as special rates as generally they are offered for a specific period of time. Let's start by looking at the difference between base rate and lender's variable rate. Base rate is set by the Monetary Policy Committee, or MPC, who meet 8 times a year. Base rate is the rate the Bank of England charges other banks and other lenders when they borrow money. There's another pricing system called SONIA, but it's less common, so I won't explain that in this video. Base rate influences the interest rates that many lenders charge for mortgages, loans and other types of credit they offer people. What's important is that base rate is set by an external body. Next we have lender's variable rate. This is set by the bank or building society themselves, and they may change this rate as and when they choose. Although they do broadly reflect movements in base rate, they're not directly linked. Often this variable rate is referred to as standard variable rate. However, it's not standardised across the industry. As you can see at the date of this presentation, there's over 1% difference between the lowest and the highest variable rates illustrated. Both base rate and lender's variable rates change as market conditions require or lending appetite changes. Next, we'll look at base rate tracker mortgages. A base rate tracker is a variable rate mortgage linked to the Bank of England base rate. And interest is charged during the special rate period at a margin above Bank of England base. So as Bank of England base rate moves up and down, so does your payment by a set amount. Next, we'll look at discounted variable rate. A discounted rate is usually linked to the lender's variable rate, and during the period of the special rate, you're charged interest at a margin which is below the lender's variable rate. Now remember, the lender's variable rate is set by the lender and they can revise their variable rate when they see fit. It is possible, for example, they will not mirror a reduction in Bank of England base rate straight away or even at all. A fixed rate is set for the duration of the special rate period and it doesn't change regardless of movements in Bank of England base rate or the specific lender's variable rate. A risk of the fixed rate is that you may enter into a rate contract that becomes uncompetitive if the interest rate environment moves downwards. Most special rates, regardless of whether they're fixed, tracker or discount, are given for a set number of years, anything from 1 to 10 years, or to a specific end date. There are some special rates that do apply for the duration of the loan term, although these are few in number. At the end of the special rate, you'll have a number of options. Most lenders will offer an existing customer rate which you can switch to, or maybe it will be better value for you to move your mortgage to a new lender. However, if you do nothing, your mortgage will revert to the lender's standard variable rate. Choosing the right type of special rate depends upon many factors: your monthly budget, how long you plan to live in the property, your attitude to risk, your opinion on the economy, your age, if the property is a compromise or your forever home, your career or your personal plans. At We Are Money, we ask you the right questions so that you end up with a mortgage that best suits your needs and future plans. At the end of one special rate, we'll help you again and make a fresh recommendation to match any changes in your circumstances or your future plans. We hope you found this video really rather useful. Check out our YouTube channel for videos on other topics or visit our website at wearemoney.co.uk.